friends, your favorite Chicago real estate agent Anastasiia Hurtova is here, and today we have the most interesting topic to talk about: real estate property taxes. I know that taxes can be very confusing for many people, and I'm here to make it a little bit more understandable, digestible, and hopefully you will have a little less questions about real estate property tax. So real estate property tax is something we pay annually when you own a property. But when you're in a transaction to buy or sell a property, the way real estate taxes work is a little bit complicated. So first of all, let's start by saying that real estate property tax in Chicago is paid in arrears. What it means is that today in 2023, we're paying property tax for 2022, and next year we'll be paying for this year. Real estate property tax bill comes out twice a year. You have one amount, but it comes out as two bills. The first installment typically comes out by the end of January every year and is due by March 1st. And then the second installment is supposed to come out by the end of June, was being due, you have to pay it by August 1st. But the thing with Cook County specifically is that it never happens like that. So unfortunately, our second tax installment is always late. We are filming this on October 19th of 2023, and we just received our second installment earlier this week. So what does it mean for you as a buyer in a transaction? When you're buying real estate, let's say you're buying your home on January 10th of 2024. At that time, we will not yet know the tax bill for 2023. And on top of it, you as the new owner of the property in 2024, you did not occupy the property in 2023. So the question becomes, who is responsible for paying for the taxes for that year? The answer is you will get a tax proration from the sellers. It is one of the things that we negotiate in the contract, is how the taxes will be prorated. So what it means is that the seller is going to give you a credit to pay the tax bill when it becomes available. And typically, because we don't really know the total amount, we can never really estimate it, and it's very rarely the same as it was a year before. When we negotiate a contract, we ask for anywhere between 105 to 110% of the last year full known tax bill. By getting that credit from the seller to pay the real estate property tax when it becomes due, it essentially lowers the cash you need to bring to the closing. So when we talk about buyer closing costs, all the title company fees, lender fees, and other fees that you need to pay when you're buying the property, by getting that tax proration from the seller, it essentially lowers that number down. So to sum this up, first, you will not be responsible for paying the tax for the time that you did not own the property. The seller will give you money to pay that tax bill. However, the seller will not issue you a check. They will give you a tax credit, which will deduct the amount that you need to bring to closing. When you're buying a property and you're putting less than 20% down payment, you have to have an escrow account set up together with your mortgage. So when you make your monthly mortgage payment, what happens is there is a part of the mortgage payment that covers principal and interest, and then you also pay taxes and insurance. So the taxes, essentially what they do, they estimate your yearly tax amount and they divide it by 12. So every month you're paying 1/12 of your tax bill that goes into that escrow account, and the money sit there until the bill becomes due, and then the mortgage company takes the money from that escrow account and pays for your taxes. So if you have an escrow account set up to pay for the taxes and homeowner's insurance, you will still get the tax bill in your mail, but you don't need to do anything with it. You just wait for the mortgage company to do what they're supposed to do. They'll pay for it themselves. If you're putting 20% or more down payment when you buy a property, you have an option to opt out of having an escrow account, but you can still decide to have it. Essentially, when you opt out from having an escrow account, what you really need to do is you need to create one yourself. You need to create an account which you can use to keep 1/12 of your estimated tax bill, and you need to put that money over there in that account and not spend them, because when the bill comes, it can be a pretty substantial amount. It can be $4,000, $5,000, $6,000, depending on your annual tax bill, and you don't want want to be in a position where you don't know where to get the money to pay the bill. So you have to be really diligent and smart about like still having the same idea, the same concept of an escrow account, but just doing it yourself. But again, this is only an option when you put 20 or more % as the down payment.